My pamphlet is a response to the current banking crisis. I set the crisis in an historical context, but my message is, I think, a very contemporary one, and I argue in particular that the Bank of England failed in this crisis to carry out its traditional role of acting as, we sometimes say, lender of last resort to the banking system, but really as banker to the banking system. It's not the only reason there's a crisis, but it's a very important one. And what I try and do in this pamphlet is to set out an agenda so that something of this sort won't happen again. Banking is a strange sort of business. We leave our money with banks for safekeeping, and you might think that behind the counters they have banknotes like this that equal the value of the deposits that we leave there. And that indeed is how banking began. There was 100% backing for our deposits. But over time, our banks realized that customers didn't want all the money back straight away, and that in fact they could lend this money out. And by lending it out, they received an interest from their customers, from the borrowing customers. They could pay interest on their deposits. And over time, the ratio of cash to deposits, the ratio of cash in banks' tills to deposits, fell dramatically. One of the processes which furthered this was the realization that some banks are particularly good at managing cash. They became specialists in cash management. Reserve banks. They need to be safe banks, and so the obvious candidate was the banker to the government. So what happened was that the cash reserve banks became what we call a central bank. And when the rest of the banking system, the run-of-the-mill commercial banks, realized that a central bank existed and that this bank could lend them if they got into cash trouble, then the banks themselves lowered their cash ratios even more. So by the middle of 2005, the typical holding of cash, that's the cash in the counters, some cash held at the Bank of England, the typical cash of the British banking system was less than 1% of its assets. It's gone from 100% to less than 1%. That was the way in which banking had developed. And the existence of the central bank, the Bank of England in the British case, as the banker of the banking system was critical to that process, because the banks thought that if they had a problem with getting cash themselves, because they've got to pay it back to us, then the Bank of England would help them. There was ample historical precedent for believing that. Well, in the summer of 2007, the international interbank market closed up. It closed up for all sorts of reasons, but many of Britain's banks had themselves depended not only on deposits from us, their customers, but also on the international wholesale market for their funding their balance sheets. And it would have been reasonable to expect help from the Bank of England, or at any rate from the British state, in the problem that was then emerging, given all the historical precedents for it. But the Bank of England didn't do a very good job. And Mervyn King, the governor of the Bank of England, even proposed a doctrine that it wasn't the Bank of England's job to extend finance to banks for an extended period of time. Instead, he said this is a job for the private sector or the government. It's an entirely new doctrine. In my view, it was wholly wrong. And the result was that in late 2007, Northern Rock had difficulty funding its balance sheet and was eventually taken into public ownership. And then, as the crisis in the interbank market worsened, by the end of 2008, autumn 2008, virtually the entire British banking system was in difficulties funding its assets. Not just Britain, by the way, all around the world there were these problems. The correct answer, and it was part of the answer in October 2008, was for the government to guarantee the interbank borrowings to the British banking system so that over time the difficulties the banks were having could be resolved. That was what happened, but the government imposed all sorts of conditions on Britain's banks and in effect penalised them for managing the assets badly, managing assets and liabilities badly. In fact, Britain's banks had complied with the regulations, and the shock from the international wholesale market hadn't been foreseen by anyone. The question is, why didn't the Bank of England in this crisis act as it had done in previous crises? For example, the crisis in the mid-1970s, again because of the closing up of the interbank market, which affected the secondary banks. I think there are various reasons. One reason, as I said, was the attitude of the governor, Mervyn King. But also relevant here is the capital of the Bank of England. Obviously, when the Bank of England itself lends to banks, helps them with their cash problems, or if the Bank of England guarantees an interbank line, the Bank of England may lose money on these activities. So the Bank of England needs some capital of its own against those risks, but it also needs an understanding with its shareholder. Now, at the moment, the shareholder for the Bank of England is the British government. So the Bank of England had to discuss its problems in the system, problems the Bank of England had helping the system, with the Treasury. The Treasury, I'm afraid, at that time didn't have any bankers. The Treasury had officials who knew very little about these topics, and the result was a shambles. What I propose in the pamphlet is the following: that the Bank of England should be privately owned in fact by banks. People think that's very startling. That's in fact how the Federal Reserve in America is owned. That's the pattern of way in which the Americans organize their financial system, central banking. And the banks would have a strong incentive to make sure that the Bank of England did not lose money on its loans. So it would be in favour of prudent banking. On the other hand, they would want the central bank to help them in their cash management, as had been the historical obligation, duty of the Bank of England. That was one point. Second point was that the capital should be a large amount of capital to deal with a potential crisis. And I suggested roughly 1% of national income. It's for discussion. It's quite a lot more capital the Bank of England currently has. I also suggested that there should be a clear legal framework for any transactions between the Bank of England and the banks, and a clearly specified legal obligation on the Bank of England to help the banks in certain circumstances, so that the uncertainties of the summer of 2007 couldn't be repeated again. By the way, it's very important, now that the British state does own some banks, that when these are sold back, the banks are worth something, and the banks are worth much less than they ought to be if they're not sure about their relationship with the central bank. I also said in the pamphlet that the job of a central bank is very wide-ranging. Under Mervyn King, the Bank of England had become in effect a glorified economic research department. No. The central bank is banker to the banking system. That's its first job. That's why there's a central bank there at all. And the relationship between the central bank and the commercial banks needs to be strong, clarified, and so on. And the central bank should be responsible for the regulation of banks and the supervision of bank balance sheets. That's always been a tradition. If it was tradition before 1997, that's the way things ought to be. The Bank of England also ought to be responsible for the management of the British government's debt. The management of British government's debt is part of monetary policy. That's become clear as this crisis comes towards, we hope, its closing phase. The key measures to revitalise the economy have indeed been action by the Bank of England to buy government debt to put money back into the economy. It involves management of government debt. So to summarise, I'm in favour of a central bank that has a wide range of responsibilities. I regard my proposals as in line with the best traditions of British central banking. They go back indeed to Walter Bagehot, so-called, in some ways, the first theorist of central banking, who put forward some of these ideas in 1873 in a book called Lombard Street. And I'm very much opposed to the idea that the central bank should simply set interest rates and its banking role can be dropped, which in fact was first put forward by David Ricardo in a pamphlet in the 1820s and 1830s. So I'm in favour of a broad central bank, a Bagehotian central bank, not a narrow Ricardian central bank.
So if I may ask, therefore, about the relationship from what you're saying to the capital adequacy rules in international banking, the Basel rules, and how you see the relationship between the central banks and the Bank of England.
One issue here is the relationship between banks' cash and their assets, which I've already discussed, gone from 100% to 1%. Another one is the relationship of banks' capital to their assets. The banks have got capital there to act as a cushion in the event that there are loan losses. It may amaze you, but in fact the typical capital to asset ratio of most banks is 5%. They're geared up 20 times. The point, of course, is that, at least in theory, all the assets should repay at least at par, so that our deposits, which are 95% or so, 90% or so of banks' liabilities, are safe. A lot of things to say here. One of the points I emphasised in a pamphlet was that the lower the cash to asset ratio fell, and the lower the capital to asset ratio fell, the cheaper the services that the banks provide to us as their customers. And that is very, very important. Look, it's very easy to have a safe banking system. You have a banking system where all of its assets are cash. Obviously, nothing can ever go wrong. You have a banking system which has got some loans, but where capital is 30% of assets. Again, as long as the loans are repaid, nothing can ever go wrong. But that kind of banking system will charge its customers a lot for any loan. And in 2005-2006, the margins in British banking were wafer thin because the capital ratio and the cash ratio were very, very low. I am in favour of low ratio banking. I'm not in favour of 100% cash ratio banking. I'm not in favour of high capital asset ratios. Those will increase the cost of services to us, the customers. They'll increase the cost of financial institutions who use the bank's customers. They'll increase the cost to manufacturing companies and so on. Public policy should try and get the cost of banking down. Now, the problem with the Basel rules was they tried to set a level playing field across all the different centres. They have failed. The crisis in the international interbank market said that basically banks didn't trust each other. They didn't accept that the rules were working. Difficult problems. My view is that in the long run, international interbank lending is a good thing. It increases competition. Low capital ratios also are a good thing. I think that perhaps we should let the private sector carry out some work on bank balance sheets, produce analyses for banks when they lend to other banks, when they borrow from other banks. It doesn't need to be done by international regulators. They've failed. The regulators have failed, frankly. And also, I would say that maybe we can have central banks competing, different countries competing. They all want safe deposits, safety with their deposits, but they also want competitive low-cost banking systems. Competition rather than international regulation may be a good idea here.
Just one final question, if I may, and that is that it's become a bit of a political hot potato with an election in the offing as to the relationship between the FSA and the central bank, in Bank of England in our case. Do you have a view on where the central bank should fit into that relationship?
Historically, the Bank of England was responsible for regulating Britain's banks. So regulating is to some extent to misunderstand what was going on. When my bank lends to me, I have to give my bank lots of information. The bank wants to be confident that it's going to get the loans back. And by the way, I have to give it information all the time, and I'm in touch with my bank manager all the time, as are most companies, as are most businessmen. The Bank of England may, from time to time, in emergencies, need to lend to the banks. The Bank of England is the only issuer of cash, and the banks must repay deposits with cash. Therefore, the Bank of England, as a banker to the banking system, as any other bank, must have lots of information about the companies, the banks, to which it may have to lend. That isn't really in any way surprising, that's normal. By the way, in America, before they had a central bank, they had clearinghouses. The banks all belonged to them, private banks all belonged to them, and the clearinghouses had inspectors. It was all totally private, but the private sector, but the clearinghouse appointed inspectors of bank balance sheets. So that job clearly lies with the Bank of England. It should never have been taken away in 1997. I'm amazed, in fact, that there is some academic literature that you can split these things up. They clearly are related. Having said that, there are other parts of the financial system. There are capital markets, there are insurance companies. I don't think that the Bank of England has any particular responsibility for capital markets. That's for discussion. I also don't think the Bank of England should have any kind of guardian role or any supervisory role really over investment banks, and of course that's a large debating topic at the moment. My view, investment banks and commercial banks are very different beasts and should be kept apart. Again, very debatable. And I certainly don't think the Bank of England should be involved in insurance. And one aspect of the Conservative proposals just recently come out is to put insurance with the Bank of England. I really can't see that at all, and one has to wonder quite what's been going on here. That is not a clever idea at all. So I think actually Britain had a good system up until 1997. As far as possible, we should try and restore that. I just finally say that regulation. It sounds like there are these officials from on high who are bossing people around, and to some extent that is what's going on. There's a different tradition, which actually was our tradition in the historical long run, that all of us are under the law. The body of law built up by precedent must also support a statute, and it says that certain things are fraudulent, certain things are amount to theft, certain things are breach of contract, and so on. We can regulate ourselves under the law. Before 1986, Financial Services Act 1986, the British tradition was self-regulation under the law. We can get back to that, recover much of that tradition, and reduce the involvement of the state and state regulation in these activities.